Have you been keeping an eye on the move that we saw in yields? Obviously, we had that big spike up last week or more than a week ago here. We've obviously subsided a little bit here, but most people seem to think that, the path of least resistance is definitely going to be higher here. How does that factor into your general outlook, Margie?
Well, I think people are going to be disappointed with the increase in Treasury yields. I look at the 10-year myself, and we've been in now, I think, for 2 years, a 1.25, say 1.75 range, pretty much that whole time. And the market has a very hard time getting above 1.5 and staying there. And I think that we may see the top end of that range, 1.75 in the 10-year. That will be enough to slow business. It won't have an effect on inflation. And so we think we are doomed to be in a very low interest rate environment as far as the eye could see. That's what the Fed wants, and they're the ones that have the ability to make that true.
Do you extend then into some of the yield-seeking behavior into credit, given the strong balance sheets of corporations?
Well, I think high yield is still an attractive risk asset. The problem with high yield is those yields are also very low. Basically, 3.5% to 4.5% is the high yield market compared to 1.5% in treasuries. That's not a lot of extra yield. And when you look even at the equity market and say, well, how much growth do I need from dividends and capital appreciation to equal the return in the high yield market? It's just a few percentage points. So I think that you're going to see the equity markets do better than really any part of the fixed income market. But high yield, because defaults are low, I think will be the best part of the fixed income market. Even if treasuries push up, I think those yields will hold, those prices will hold.